Hello everyone and welcome to the second GRC Summit Leadership Series. My name is Peter Bannister, Senior VP for GRC Solutions at MetricStream, and today I'm coming to you from just outside Washington, DC. The GRC Summit Leadership Series, hosted by MetricStream, is an exclusive and focused sequence of virtual thought leadership sessions to discuss trends and best practices in managing governance, risk, compliance, audit, and IT GRC programs with a spotlight on resilience and performing with integrity. This series is conducted every month as a prelude to the biannual GRC Summit and covers in-depth analysis of current trends, regulations, challenges, and best practices for mid-size and large-scale enterprises from across the globe. These monthly editions, as part of this series, delve into key industry verticals like healthcare and life sciences, banking and financial services, manufacturing, and cyber, amongst several others. The GRC Summit Leadership Series event today focuses on banking and financial services industries. Our theme today is fortifying risk and compliance programs for the future. We have numerous engaging panel discussions, customer experience stories, and fireside chats planned for today. With that focus on fortification of risk and compliance programs for the future, we're going to focus on readiness and reliability with effective continuous control monitoring and aligned to thrive, integrating risk and compliance programs across the enterprise and optimizing compliance programs in a dynamic and distributed business. Our esteemed guests today represent 12 different organizations from 7 countries across 4 continents. And we thank each and every one of them for making this truly geographically diverse. So let's get started. To kick us off, I would like to welcome MetricStream COO, Gaurav Kapoor, for his opening remarks. Gaurav, over to you.
Thank you, Peter. Today, I'm really excited about the stellar lineup of speakers that we have for the entire day today, and mostly surrounding banking and financial services. This industry really serves as a barometer of the fiscal health and, by extension, the fiscal health of the world economy. It has been really fascinating to see how swiftly governments, regulators, organizations have been aligning and realigning priorities in this time of crisis. Banks and financial services firms are operating at a much higher level of hypervigilance, as I call it, continuously revising their pandemic playbooks, even as some of the world's strongest economies are reeling from the shocks of a disrupted environment, revenue, and unemployment in many cases. The opportunity to meet these unprecedented challenges and, in fact, thriving by responding with agility is showing up as banks and financial services adapt their services, their innovation, and their services around the virtual world. This includes really providing the right amount of liquidity and support to customers who urgently need them, enhancing remote sessions, for investment portfolio advisors, rapidly bringing fuller function and easier to use digital payment processing to customers wherever they are in the world. All the while, these services have to be more secure than ever, and completely resilient and able to scale to the nature of work and businesses as they continue to evolve over time. And not just banks and financial services, but everybody from asset management firms to, if you look at fintech companies, to insurance companies, they've all stepped up to the game. And as the market evolves, there's still uncertainties in the market. And as they evolve, they are using different techniques, tools, processes, people to actually solve these problems. At MetricStream, we strongly feel that the need for governance, risk, compliance has never been greater in the world, and therefore the challenges and opportunities for GRC and integrated risk management has never been more than before. The velocity of risk has changed. I talked a little bit about this earlier, and the velocity of risk, the awareness of the velocity of risk has gone up significantly and quite dramatically. Companies that earlier used to exclusively focus on risk assessments on a few factors like likelihood and impact have started realizing that velocity and connectedness of risk is also rising. and therefore they've had to change their methodologies of risk assessment and understanding risk. We also see a significant change in what we call the peripheral risk vision, where traditionally companies have looked at within the frame, within the system, kind of risk information to measure, assess, and react to risk. Today, they're starting to look at what we call peripheral risk information coming from both inside and outside the domains of their organizations to be able to manage risk better, and are also leaning on market information, market data. Sometimes many of these financial institutions are coming together to create benchmark and market information that they can share and react to much faster than before. We also see, the whole concept or advent of continuous monitoring, the use of artificial intelligence technologies, ML, to be able to automate more and more as the market starts to move more towards what I call first line of defense. We've realized from COVID that, the people who are sitting in the second and third line defense are not always, may not have necessarily the frameworks of responding to risk very, very quickly. And therefore, the transition to the first line more and more in their ability to empower the front line to be able to react to risk, also gather information that the organization can actually work on faster. So, and like I said earlier, the last and but not the least, we are seeing a significant trend towards agility, where companies are not waiting, for these 12, 18 months of risk adoption. They have to do it much faster. They've got to do it more agile way, whether it is in terms of process, people, or technology. Now, as you know, MetricStream has been very active with our banking financial services world, and customers, and we're very excited to see that innovation is happening across, the financial services world, not just over the last 3 months, but over the last couple of years, just accelerated by the awareness that the COVID and the pandemic has created for these organizations. And we're seeing more action-oriented analytics. We're seeing more risk that companies are willing to analyze. And in some cases, the leading edge companies are also looking at this as an opportunity of how to, see the changing world, whether it's on innovation, whether it's the practices of the consumers, whether it's digital payments, etc., how they're using that opportunity to actually take a further process of orientation in the markets. Let me give you a couple of examples before I hand it back to Peter for the rest of the GRC Leadership Series, Summit GRC Leadership Series. So one example is one of the largest European investment firms has rolled out or is rolling out a comprehensive firm-wide risk program with literally thousands of users with all lines of defense contributing to what we call a 360-degree analysis of risk in the organization. And it's powered by automation, powered by AI, powered by what we call continuous monitoring, in a very agile way, fleet-footed and agile way, and doing it what we call in bite-size progress steps versus trying to boil the ocean overall. Similarly, we have a global insurance company that has deployed a MetricStream platform along with other ancillary and peripheral tools and technologies to create a digital compliance platform to address changing regulations, policies, procedures, compliance controls, and not just at a federal level or a country level, but down to, in some cases, the state or the province level to be able to manage this better. And similarly, a large national bank has moved quickly to adopt our cloud solutions to support work from home while still maintaining the confidentiality, integrity, and availability of key information that are used in assessments across their business. At MetricStream, our whole product strategy is focused on 5 A's, agility, AI, automation, APIs, which is all about integrations, and analytics, which are going to power the new normal of integrated risk management. As Peter mentioned, the theme of this session is really fortifying risk and compliance programs for the future. And GRC, or integrated risk management, is really turning over its head in terms of how this is going to evolve over the next couple of years. We're already starting to see that evolution, but more and more is going to happen as we come along. Now, more than ever, we are seeing banks, financial services firms focusing on agility, transparency, and valuable and timely insights into risk that exist throughout the evolving interconnected financial system. We are seeing our customers reimagine the future in ways that will not just help them, but also the society, and build trust, reputation of the industry, and which is all about performing with integrity, which is, as you know, MetricStream's brand theme. But increasingly, as I've talked in the past, integrity is going to drive performance for a lot of organizations, particularly with a changing face of millennial and Gen Z consumers as well as employees. And as companies put the foundation of performing with integrity, we will see a lot more progress and in terms of how they are dealing with risk in general. I'm sure many of the speakers today have their own stories to tell and inspire us all. And I would wish you a very great event over the next few hours. And thank you again for joining us.
Great. Thank you, Gaurav, for setting the stage for today's event. And I totally agree. Connectedness and velocity, I don't think can be argued, are now top of mind for execs across BFSI. And to prove that this is live today, I think you can hear my daughter just outside the door. Apologies for that. Ops risk, credit, market, reputation, strategic risk, and even compliance and conduct risk all have been discussed and debated, their connectedness as we've moved through and continue to move through this pandemic. So now it's my pleasure to introduce Philip Beniak. He's our Managing Director in Australia, New Zealand region, and he's going to facilitate our opening keynote on fortifying risk and compliance programs for the future. Philip, over to you.
Thank you, Peter. Thank you, Peter. It's great to be part of the GRC Summit Leadership Series. As Gaurav mentioned, in all industries, enterprises operate in a fast-moving but erratic environment. Fast risk identification and remediation protect enterprise value and bring predictability to performance. Undoubtedly, the financial service sector is one of the most highly regulated sectors on this forefront. Down under here, we not only see regulators, but customers changing fast. The velocity at which they change can be doubled down with what we would say ferocity when they act upon delinquent behaviour. Financial service organisations really need to build that integrity equity. That's all the more important. Today, let's hear from a professional who lives in that world. His team helped define that balance between performance culture and ethics conduct. We will see the compliance team and the conduct programs help facilitate changes across the banking support functions, and also to understand how the compliance team can enable for the long-term revenue and obviously enhancing reputation. Let me proudly introduce Chris Linder, Chief Compliance Officer and Executive for Conduct Risk at the National Australia Bank. Chris is a risk executive with experience in the financial services area, covering compliance, conduct, operations, financial crime risk, as well as forensic accounting irregularities. With over 25 years experience spanning the UK, Asia, and Australia, New Zealand with Big Four consulting firms and global banking conglomerates. Good morning, Chris. Very good morning, a very early morning here down under, and thank you for giving us your time.
Good morning, and thank you for inviting me.
So, as Gaurav mentioned at the opening, we're seeing several market themes with risk and compliance, that being velocity, as I mentioned before, and regulatory change, and moving the whole process to the first line is very important, and also that leveraging automation, artificial intelligence, machine learning, etc., with an almost ever decreasing time to value. So, Chris, the first question is, what are the three top risks or challenges you see in today's environment?
Well, I think first and foremost, with the changing environment under COVID, is the risk of our people. And what I mean by that is retaining those that we have. Australia is a very small market, and what is key for me and for us is to retain critical people that we need to keep our function operating at 100%. The second one is on technology. So investing in the right technologies to help us do more with less. And we've invested quite significantly over the last 2-3 years in a lot of reg tech to help us to that end. And possibly the last one is getting better insights from an analytical perspective from some of the data that we are starting to develop as a bank. And so those are probably the top three for me.
You touched on this sort of current pandemic situation, and clearly there's a question we've got to ask at every conference, I'm sure, or every fireside chat. But what I'm really specifically and specifically in Australia here, but I'm sure it's across the rest of the world, we're starting to see regulators having to have that balance between that upholding requirements, but also the levels of stringent security that are required. What's your view on this?
Look, I think the regulators are playing a very important part in helping us get money to customers quicker and not dropping their guard, but allowing us to do more quicker. We've had a lot of interactions with them over this period to ensure that as we possibly loosen up some of the requirements that we may have had in the past, that we're still maintaining a strong financial system and we're still protecting our customers and those who we deal with every day. So they've actually done a really good job, certainly here in Australia. They've been very open to engaging with us when we've gone to them with requests for on insights on ways in which we can improve the speed to helping customers. And we've also worked not only with our regulators, but also with government who've helped us look at some of the legislation that we're currently complying with to expedite, again, what I said around getting money to customers quicker. So there's been a very good partnership here, and it's actually happened quite quickly. There hasn't been, as we know, we're working sometimes with regulators in the past where it's a difficult job for them as it is for us. And sometimes these things have taken time in the past. But COVID has shown us, not only with the way that we work every day, but also dealing with them as regulators, that we can do things much quicker. And I hope it continues, actually, as we move through this pandemic.
Yeah. In a recent fireside chat, the CEO of MasterCard, Ajay Banga, spoke about the drivers that allowed MasterCard to grow by what we would call 15x over his current tenure. The drivers were innovation, clearly, and you touched on that as well, but also this element of resilience, inclusion, diversity. It also mentioned climate awareness as well. In stating all that, he spoke around integrity and conduct that have become one of the biggest drivers to hold brand and shareholder value. He said that it's gone from a checkbox to truly understanding and driving culture, a culture of compliance. Chris, how do you see this?
Look, I think for those who are watching this and who are compliance professionals, I think arguably one of the most difficult professions to be in. Managing, our obligations, the laws in which we operate in the countries that we operate at, the same upholding conduct of people that we're working with, is a very difficult balance. I think I often refer to it when I talk to our board as the sort of the holy grail of risk management. Managing conduct in a large organization, it only takes one or two individuals who can upset that balance. And it can affect your brand if it's not handled appropriately. But I think the best way for me to probably explain it is the way in which we've built our team at NAB, which is that we're a mixed bag of, I shouldn't say mixed bag, we're sort of a collective of different professions, being from accounting to legal to enforcement to ex-business bankers. And that diversity of thought, as I like to put it, is what makes us a really strong unit, so that we can bring the voice of conduct and compliance to the organization.
That's very good. In terms of fintech and the disruption it's making. And I know we spoke about this before. This element of changing in the dynamics. Fintech disruption is causing big changes to the financial services market here in Australia and across the world. In that balance, there's also the view around lower regulatory guidelines to assist fintechs to operate faster. There's probably two questions in this, Chris, but how do you see regulators keeping pace with this innovation and this lightening of the regulation? Is that something of interest or concern to the large organisations, the big banks?
Look, I see it as an opportunity for us. I think the fintechs have shown us that being nimble is a better way to get to market, or an easier way to get into market. I think the opportunity for us to learn from them is there. I think regulators have done well. They have created an environment where they want fintechs to thrive. I think they see it, and I know that we believe it to be a good way for the industry to enhance. Some of the bigger banks take over these fintechs, some fintechs, when they are successful or they are ancillary to their business. So I think it's promising for us. I think Australia has done, as I've said, have done really well. The regulators that I know who have helped support bring out new fintechs. I know there's a hub here in Sydney. And I've been involved in, even before I joined the bank, with some who are involved in the financial crime space. I see it as an exciting opportunity, and I hope that we continue to learn from them as big banks, because it does help. And the interesting part is the people that we work with want to be involved in that energy that the fintechs bring. They like the environment that they can create. And not to say that our organizations don't have that, but in a smaller organization, it's easier to get that culture in quite quickly. So bringing that culture into organizations is really interesting time.
Yeah, no, it is, and actually, I see that well as in the market as well. The acceptance and the adoption of fintech's capabilities actually really is changing the landscape here in Australia. In terms of, and really, it's just your background, Chris. I mean, you've got, you've had advisory roles in KPMG and Deloitte's. You've had serving leadership roles in Deutsche Bank and also now recently NAB. And this, in all this area of compliance and conduct. And probably the question is, we've got people on the call here. What advice would you give them? What would you sort of share to be a takeaway from this conversation?
Look, I think one thing that I've learned over my career, and certainly been lucky enough to have worked in various markets, as you've said, and for different organizations, one of the things that has remained true in way I've worked is the people. I think in our discipline, people matter the most. We could have the best tools, we can have the best kit, we can have access to as much data as we want, but the people are the ones who bring that to life. They're the ones who create what we refer to as the voice of compliance, and they help us manage conduct across our organizations. I think, I often say to my team, make decisions when you know what you are talking about, whether you're day 2 on the job or whether you've been 30 years in the same organization. Have the courage of the conviction. Compliance is actually a very interesting, but it's also a very lonely profession. You're making decisions for organizations that can have a ripple effect across the way that other people work, in not only in our organizations, but in the way that we deal with customers. So probably my advice is stay true to what you believe in. Rely on the people that you work with, and trust what it is that those people bring to you, and use that diversity of thought to better not only your own compliance function or conduct functions, but to better the organizations that we work with. People, to me, matter most.
Yeah. Okay. So, Chris, I really appreciate your insights. So my takeaway notes are keeping the teams engaged, leveraging, obviously, what I think you mentioned, RegTech, infrastructure. And I think just really having compliance programs that serve the customer, the regulators, the shareholders, and also the employees. So, Chris, thank you very much for the opportunity of spending some time with you, and I can pass it back to Peter. Thank you.
Thank you, Chris, for such a powerful opening keynote. We now have our first panel discussion on readiness, reliability with effective continuous control monitoring. This session will focus on improving test coverage and effectiveness, improving the overall compliance posture, and reducing cost and elevating compliance awareness.
Hi, my name is Susan Palm, and I'm pleased to welcome you to our discussion on continuous control monitoring. Joining me today is a distinguished panel of experts who are at the front lines of control monitoring in their organization, and each one of them brings a deep career of experience and leadership to today's conversation. I apologize that time doesn't allow me to share their full credentials. Joining us today is Robert Milden, who serves as Vice President of Egrc Integrated Solutions at Fannie Mae. Robert leads the team responsible for the digitization of risk management, including the strategy and the execution of Fannie Mae's Enterprise Governance Risk and Compliance platform, which integrates data from multiple sources to identify, aggregate, and quantify non-financial risks. Before joining Fannie Mae in July of 2019, Mr. Milden was an operational risk executive leading the implementation of Egrc capabilities at Wells Fargo. And prior to joining Wells Fargo, Mr. Milden spent 20 years at Bank of America, where he served in a variety of roles, most recently as a quality control executive. Welcome, Robert. Natish Anand is the Chief Control Officer at Hsbc North America. Natish has been with Hsbc since 2006, having held a number of leadership roles within the global private bank and more recently within the global liquidity and cash management business. Currently based in New York City, Natish is the Chief Risk Control Officer for North America with responsibility for ensuring appropriate first line of defense oversight and governance. Prior roles include Director of Business Management, Global Portfolio Director, and as a Chief Operating Officer of the private bank while on international assignment in Panama. And rounding out our panel today is Ivan Martinez, Chief Audit Executive of Banco Santander in the London branch. Ivan has over 15 years of audit experience in financial services and currently leads the internal audit team at the Banco Santander London branch, the main corporate and investment banking franchise in the UK. He is responsible for defining the assurance plans for relevant risks, including market, credit, IT, cyber, financial crime, and operational faced by Banco Santander. Welcome, Ivan. Welcome, Natish.
Thank you.
And now, panelists,
thank you very much.
Get started. Continuous control monitoring has been at the starting gates, waiting for its time for years, looking to gain traction. Why has it taken so long for this practice to become a sustained operation? Robert, let's start with you.
Sure, and my answers, Susan, will represent experience across the large financial institutions. You know, there's always competing priorities, but I think more importantly is the realization that you have to understand your control environment so that you can prioritize work and resources across the board. Understanding your process risks and controls and how they all interrelate, looking at, do you have the right balance between automated and manual controls, detective and preventive controls, getting the organization to understand their process risk and controls, to then implement continuous testing in a way that makes sense so that you can focus those resources, has been a lot of the legwork that's led to the delays, if you will, of getting to the continuous testing.
What's your perspective on the long road for this process? Ivan, what's your thoughts
Sorry,
on this?
I didn't hear you. I think, as my colleague said, I think this has been a journey from the detective controls to preventive, and also one of the key moments on doing this jump was the development of certain tools that help to automate controls and help to automate certain processes as well. And from internal audit perspective, I think one of the points that we value more on first and second lines are the assurance or reviews of the completeness of this catalog of controls and the frequency of these being run.
Mm-hmm. Thank you. Natish, tell us about Hsbc.
Sure. In addition to what my fellow panelists said, I point to two different things. One being around our current framework or our prior framework of control testing, which was done by a dedicated number of risk professionals. And we didn't want to lose that level of expertise and diligence as we transition to continuous monitoring. And I'd say the second one being around the sheer volume of controls. As a global organization, we have global controls, we have business-owned controls, we have regional controls, and we have global controls. So we wanted to ensure that the level of rigor and oversight of the continuous monitoring was done at all levels, and the reliance by the businesses on those controls could be consistent across the group. So I think it's a combination of both not losing our prior experience of control testing or point-in-time testing with the advantages and clear distinction with the framework of continuous monitoring.
While we define control testing as somewhat of a siloed set of work, it's clear from all of your answers that control testing relies on so many other elements being well defined. Like Robert was talking about the business process, being well defined. Ivan mentioning also the standards for this work. And of course, prior to getting your arms around this, every line of business had their own definition of their controls, and rationalizing that, as you said, Natish, that large set of controls was a project. How do you govern the standards for control data information? Natish.
So from a control standpoint, it was important that we focus on the key controls. It was important that that control library is clearly defined by within our risk taxonomy. And it was also important that the risk stewards are governing the standards by which those controls are in place, by which the different businesses and functions can link to. So it's important that as we have global controls, there may be local nuances that need to be considered. So the spirit of the control is still within the global control library, and it allows local businesses and functions to adapt, but not necessarily change the spirit of the control. And if there are local controls that are not within the global control library, there is strict governance around influencing or updating that control library as our risk and control taxonomy could change as the evolution of different risks and controls that we look at within our business.
And Natish, one other question. When you talk about global controls versus local controls, does that get represented as a parent-child relationship in your framework?
Not necessarily, because we can have global controls that are owned by a global control owner anywhere in the world, whereas local controls I would view as there's a U.S. executive that's responsible. Those wouldn't be parent-child, but we would have, for example, a global system would have a global control owner, whereas a local platform would have a local control owner. So that would be somewhat more of the distinction.
Okay, thank you. Robert, how do you think about these kind of control standards at Fannie Mae?
Yeah, so again, in the large financial institutions I've worked in, there's always been a focus on risk-adjusted effectiveness and efficiency. And we've categorized the controls into sort of three categories. Those controls that are unique to a certain business or product, those controls that are common where they can be designed once but are executed in multiple businesses or different groups across the company. And then shared controls, which are designed and executed by a single entity within the company. Being able to define that and map controls into it helps with the reduction of overall controls that need to be tested. The testing can be made more efficient through various sampling strategies. And that way you have a standard to go against across the board so that, again, risk adjusted key controls and effective and efficient as you head across the different categories.
Okay, thanks so much. And Ivan, what's the view from an audit perspective in terms of examining the standards for controls in the organization?
From our perspective, I think it's very important, as you mentioned, that there are defined standards across the different businesses, and also it's very important for us the role played usually by second line as a certifier of the quality of and effectiveness of the controls. For instance, we in Santander we run a strong certification process with several internal control program like SOX, Volca, and so on. And what we usually do, apart from independent testing of specific controls, we expect these lines of oversight to run these independent reviews to ensure standards across the board.
So it sounds like, I mean, one of the reasons it's taken a while for us to really get traction with continuous control monitoring is the first step is defining your different categories of controls and then your governance around the descriptions, the frequency of control testing, etc. So a big piece of governance has to happen, it sounds like, prior to the work that happens. How does continuous control monitoring fit into the larger program of audit and risk management? Robert?
Yeah, we can spend a day on this one, Susan. You know, it's interesting because in testing, you talked about scheduling, and we need to evolve risk management from a calendar-based event. I need to test because I flipped the page on a calendar to an event-based event. What's the trigger that alters my workflow to say, hey, I need to go test this, right? And as you have your processes, your risks and controls tied together and you tie in your issues or your loss or operational incidences or changes in policies or reg requirements, those are the triggers that will say it's time to test something. Now, the results of the testing and the continuous ability to have that is a great input for audit in the third line of defense to scope their audits to areas that are going to have a greater return or value in their finding and assessment, either certification or finding of new issues, right? And so the interrelationship between second line event, not calendar flipping a page, and audit brings tremendous information not only to the board and the governing bodies, but also to the first line and where they can get the biggest bang for their buck out of their resources and maybe make the case for further automation of controls or change processes and what have you.
And Robert, just as a follow-on, when you mentioned risk events generating the need to do the control assessment or the control testing, how do you align people organizationally at Fannie Mae for the communication of this kind of information? Can you talk about that a little?
Yeah, and again, not limited to Fannie Mae, but what we've
Right.
implemented in each of the places that I've worked is events kicking off a workflow. Part of the workflow is communication. The more information that a leader has, the better position they are to allocate resources to different activities, right? And there are some skills in testing which, forgive the word, right, are more commodity based, and there's more where you need a deeper level of SME to go in and look at the scripts and modify them and go after the point of interest. And again, the more information we can provide to them, the better they can utilize the resources available to them.
Okay. And Ivan, in your role in audit, how do you rationalize this control testing evidence that is occurring in the second line and the first line? How does an audit executive leverage that information as you perform your responsibilities?
So, as my colleague mentioned, I think for us is key this data, and to have all this data the most updated that we can. So basically, we use this as an input to refresh periodically our audit plans. So not just annually, but even half annually. So every 6 months we take all this data, we process this data, and we try to identify potential new weaknesses in the organization in terms of ineffective controls or as you mentioned about risk events that have happened in the organization that require to put the focus on the rest of the period. So for us, it's critical to get access usually to the operational risk management tools where all this data is being stored and all the controls are being also stored, and to start or to have the ability, and that is one of the points that we are seeing a trend in internal audit about skill set required, not just to test controls, but also to analyze data that you gather from first and second line. And the communication with second line in these aspects are critical. I guess that not just for us to conduct our audit plans, but for the organization to have a proper assurance program.
Got it. You made a comment, both of you. You mentioned risk management systems with an S. How much of the challenge that you have in your responsibility is linked to the fact that there are multiple places to find this information? Ivan, I'll start with you on that question.
Yeah. So I think I guess all the organizations are more or less in the same situation about different systems, different languages, let's say, in each of the systems. So try to rationalize all this data and try to get a proper program to gather and analyze this data is currently one of the key challenges for our function in internal audit. And obviously, we all try to tend to have just one golden source, let's call it that way, if possible, of systems or tool that we can put all together. And then the one of the key things is to ensure that this data is certified and is clean and is validated by the relevant control owners.
Thank you. Natish, I'm going to switch the conversation now, and actually let's talk a little bit about the control monitoring programs that all of you are embarking on. And my question for you, Natish, at Hsbc is, how did you transition from control testing, the traditional approach, to continuous monitoring?
I think so. Some of the comments around even systems, I think, can fit into this. The transition, one of the things that is required is the right platform by which risk owners, I know we're talking about control owners, but risk owners have line of sight of their local environment. So it's important that the risk owner not only see the local controls, but also controls that are being looked after by other areas of the bank, to have that full visibility from a front to back, all of the controls that would influence the risk of the business. And that's an important component of being able to go into continuous monitoring, because with that reliance, the information is only as good as the control owners are keeping it. So ensuring that there's a continuous monitoring program in place then provides some level of assurance to the risk owner that the controls are being looked after, not only on a calendar basis, but on a continuous basis. So that gives some level of comfort to the risk owner. And I think from the control owner, it also, that level of transparency in one platform provides the visibility for a control owner to know all of the different businesses and functions by which their controls are also influencing. So that transition is important, not only because from a control testing perspective, if the control is being tested, let's say once a year, then the risk owner may not know, okay, well, this control hasn't been tested XYZ time. Whereas in a continuous monitoring framework, it does give some level of comfort that these controls are being looked after from either event trigger and or any other influence that may have a view of the effectiveness of the control. So I think that the front to back for the risk owner as well as the control owner is an important component of being able to, as part of the transition to continuous monitoring.
To a comment that Robert made earlier, this interconnectedness, of the linkage between the controls to the risk. Robert, you mentioned the linkage between the controls, the risks, and the processes, is another incredibly important element. Natish, let me ask you a follow-on question. How do you ensure that as your processes change, or maybe even as regulations change, that the controls are now being reviewed in response to that particular kind of event? What does that look like?
So we have governance around trigger events, and there's different categories for a trigger event. It could be regulatory driven. It could be new systems being implemented. It could be material changes to processes. So that then leads to a review of the specific controls by the control owner, which is why I think the comment around communication is key. So for the control owners to understand any changes, so we obviously engage with our second line risk stewards, for example, regulatory compliance, that would inform the businesses of potential regulatory upcoming changes. We would ensure that the relevant control owners are engaged. The relevant control owners would therefore either add new controls, update existing controls. And the way, again, from a platform perspective, is that the risk owner would then see the changes of those controls, as well as even if outside of a regulatory change, if a control becomes less than effective, so it may needs improvement or ineffective control, the risk owner has line of sight into that. And we look at different reporting by which any changes in control ratings is flagged. Then we look at that as an assessment against our specific business. And then we ensure that our risk profile is appropriately reflected, because An ineffective control may have an impact to one business. So let's say for the retail side, it may not impact the wholesale side. Whereas therefore, it's not just that if a control goes ineffective, it impacts every business or function equally. So there's an assessment that's done against those trigger events by which to ensure that our risk profile stays current.
Okay, thank you. That's a great answer and very helpful for all of us. Robert, as you're thinking about this, what systems or practices would you have in place, or do you have in place for operationalizing this in your organization?
Yeah, there were a couple of points made today, especially about the quality of the data by the first line that the second line's dependent upon to opine over and identify the risk past the third line. And there's a tension between first and second line that I've observed in each of the places that I've been, right? And you can either have that as a healthy tension or a not so healthy tension, but the realization that the first line has to derive value and benefit by the activities of the second line is key, or the data won't be worth anything to the second line to do that analysis against. And so from a routine perspective, setting up a second line risk and compliance program owner session, ongoing routine with first line. So program owner, first line advisory council. So we can talk about the plans. We can put it from the company first perspective that says, how do we manage risk for the company? And so you may need to give a little on what's ideal for you, but having that active dialogue with people, keeping the company first in mind, leads to the processes that benefit all. And yes, there's compromise as you go. Once you get good agreement across the board on what you need, then the systems part is easy, right? Because that's the requirements, and how do you deliver for each of your stakeholders? And so that's the key that I would put out there.
Ivan, what about you? What systems or practices do you have in place to operationalize this continuous monitoring?
So basically, we usually try to build in-house tools which are fed by the first and second line systems. So we try to get online information from these systems and apply our own rules to try to do some very basic, some sort of data analysis over this information. And apart from this, in our normal audit plan engagements, we usually tend to do some kind of completeness and accuracy test on this data to check that the data the first and second line are inputting into the systems are correct and are being certified and so on and so forth. But it's true that it's very challenging because usually the organizations, especially in the industry that we are, that is wholesale activities, are very live and very changing, and the systems are changing every day, more or less, and it's difficult to maintain this kind of processes in place. But yeah.
And Peter, I would just ask if there are any questions from the audience. We'd be happy to entertain any questions as we go, if any questions are coming in. And if I could just get those questions, I'll be happy to answer them or to present them to the audience. We'll continue on with our remarks, and I'd ask each one of you. Oh, I do have a question. The first one I'll ask for the team here is, practically, do you experience 100% coverage using continuous controls monitoring? Does anyone have a sense of the percentage of coverage that they're getting? And maybe we'll use a year as the framework. Robert or Natish, what do you think you're getting in terms of coverage?
I'll defer to Natish.
Sure. I think this goes back to the first point where we talked earlier around the volume of controls, and it's important that we are looking at the key controls. So I think the coverage would be a much lesser percentage if we try to include every single control as part of every single process. So from our framework, I would say that I can't put a percentage on it, but continuous control monitoring, I would expect that all of the controls that are within our different risk and control assessments are being looked at on a frequency basis, and event trigger and or external, whether those are external events, changes in processes. So I wouldn't view it as a process, but I think that each control owner understands their responsibilities as being once someone is considered a control owner, and there's training that's provided. So there's a level of seniority for the control owner. So I would say in our control environment, I would expect that all of the controls are being looked after, whether that is on a continuous basis, and what that looks like may be different depending upon the nature of the control. But certainly every control within our platform is being looked after one way or another. And there are also reports that highlight the last time these controls were assessed. So again, if a control hasn't been assessed in let's say if we were looking at a year, it would certainly be flagged in terms of ensuring that it wasn't just an oversight of not updating the system, but that there is effective monitoring in place.
Oh, that's great.
Yeah,
So,
Natish, yeah.
Go ahead, Robert.
Yeah, no, I mean, I would have to agree, and I'd have to say to the folks that asked the question, right? I wouldn't go for 100%. I wouldn't set that as your goal, because there's going to be diminishing returns. If you understand what your high risk processes are and the controls associated with them, that's where you're going to focus. There's a lot of controls that are fine on a cyclical review, but to the point Natish made, make sure that they are reviewed on that cycle that everyone agrees to.
Right. Okay, great. Thank you for that. Ivan, any comment from you, or let me ask maybe a slightly related question. How often do you update your control descriptions? You mentioned, looking, Natish, at a report and looking at the review process, but how often do you expect, or do you have an expectation about control definitions being updated? Is there some guidance there that you would share? Natish, I'll start with you.
Sure. So apart from the event-driven, which could be the result of
Right.
projects, changes in processes, regulatory changes, et cetera, there is an expectation that controls are continuously reviewed, because as we move into the framework, as we're talking about continuous monitoring, as you're looking at the controls, if the control has changed, then obviously we would expect that the control descriptions are also being updated in coordination with the risk stewards, because there's level of expertise we look for from our second line to be able to kind of help inform any changes in our control libraries. There are refreshes of our control libraries, which are managed through our second line. So we get different risk taxonomy changes, and that frequency is different based on the risks. So that level of local controls, we certainly, from a business perspective, would be leading the charge if there's any specific local regulatory or local specifics to our business. But the actual control libraries, as governed by the second line, is on a frequency basis by which, as they're looking at it from a risk advisory perspective and their level of expertise and the change in their specific risks, they are, doing it at their, I would say, at minimum 1 year, but certainly at a frequency that is suitable for the risk taxonomy by which they're overseeing.
Okay, thank you. And Ivan, what are your thoughts about this as someone in the business of control testing? Audit typically has been. What are you expecting to see as you look in your organization?
Well, what I expect, I think, is a little bit in line what has been commented previously. What I expect is that the risk owner has a detailed sense of the list of controls that the different teams are running. They've got some kind of prioritization of the controls and identification of key controls. And what I will expect is that those key controls are being reviewed at least annually. Why? Because probably maybe there are no direct events that impact this control, but sometimes there are events that have a secondary impact on other controls that are not so direct, let's say, to see the impact or how this could change the controls. So for the key controls, I will expect that the risk owners and control owners do a annual review of this. For the rest, is more like a risk appetite based about how often to review. Obviously, I don't expect having controls never been reviewed by, but I will agree that we need to be focused on the key controls and to have this annual review on these aspects.
Mm-hmm. Okay, so you're looking for annual, generally speaking. The rest of you certainly have some governance around that as well, looking at reports, when were they last assessed? Robert, looking at trigger events in the processes. Okay, thanks for that. Are there any other questions from the audience? Oh, here's another one. How often would you check for downstream changes to the controls that were updated? So in other words, if I understand this question, if the control was updated, what are those interrelated elements, whether it's a process, a regulation, why was the control updated? How often do you check for downstream changes? Perhaps even issues or gaps, findings. Anyone have a thought on that?
Yeah, so I mean, a change in a control is going to affect a bunch of people, and we would look to trigger a work queue item the day after it changed, right? So we detect the change if we weren't aware of it. Hopefully, when we reach out to people, they were aware and coordinated in their response as to why the trigger event happened and the other pieces. Sometimes a lot of the groups that are left off from when a control changes is the impact to training or quick reference cards on executing the process or the control itself. The other team where I've seen tremendous waste and missed opportunity is the control testing group, right? The second line group. If they don't know to update their test plans and test scripts for the changes in the control, you have a pretty big miss there. And so I would just keep that going on a regular basis as the control changes.
And I'm going to ask each one of you if you had a wish list, something that you could just magically change to move this control monitoring program to even a better outcome. What's on your wish list? Natish, what's on your wish list?
How much time do I have? 23 hours?
Go ahead, you can give me a couple items.
Okay. I would say I look at it from two perspectives. So we're talking about control owners and risk owners. So from a control owner perspective, I think a dashboards for both, much more interactive dashboards that provide, here's my control, here's how it fits into the process that this control is impacting, and being able to have the dashboards when I log in and I can see all my controls and, dynamically ensure that it's, like almost like a car where you look at the dashboard. And similarly for the risk owner, having a dashboard by which to see the, log in, see which controls may have changed, what you were saying in terms of the changes to the effectiveness of controls. We have that information. It's just a matter of it's much more in reporting versus dynamic dashboards. So I think that level of flexibility, I think, and relating the controls to the specific processes that the risk owners have an interest in, I think would be very, very helpful. And I think, that goes to the comments we made earlier in terms of getting there, that, there needs to be a bit more automation in some of the controls. And, having the ability to see that from a control owner perspective as a risk owner perspective, I think would be very, very helpful.
Very good. Okay. Robert, what would you like?
Yeah, if you think about our role as really to reduce the mean time to identify risk and remediate or take action of that risk, what would be truly ideal is a way to quantify the business impact of that earlier identification on the company so that people get a greater realization and participation in the process of driving it further and further.
Mm-hmm. Mm-hmm.
Not
And
asking
Robert,
for much.
No, and does that mean you're trying to link this back to business objectives and business strategy when you talk about impact?
Absolutely. Absolutely. Putting it, I mean, again, the business exists for a reason, and that reason is not risk management, right? And so how do you
There you
put it
go.
in the terms, right? How do you put it in the terms that you get the buy-in from the people and the support from the people who are really driving revenue and profitability for the company? You're in
Right.
risk management, you're a key component to helping them achieve those goals. And an easy way for them to recognize that would be a wonderful thing to have.
Right. I know that in the metric stream GRC library, in addition to the process, risk, and controls, we have a library component called products. So companies, I've seen some of our clients use that library to define the products they sell into the marketplace, and they start creating new linkages to the product. So if the control is, at risk, to your point, Robert, why does that matter? What product might that impact as I go to market? Ivan, what's on your wish list?
I think one of the important developments that we can bring is the efficiency in the management of the programs, and also in harmonizing, let's say, the language of we use in different lines, because sometimes we first, second, and third line we use different systems, different libraries, different languages, and then makes it very difficult to be all in the same page and in the same line of work, let's say. So I think one of the good things will be that let's say that the internal control community in the organizations have same systems, same languages, and share all this information all together. That sometimes is very difficult. Yeah.
Yeah. And then what piece of advice do you have? We've asked the three of you to be on this panel because you've been thinking about this process and this movement from testing to monitoring for a long time and have had a lot of experience. You've learned some things along the way. What is the advice that you would share with the audience? Robert, what's your advice?
Yeah, so it comes down to communication and not thinking of any piece or any role being any more important than the other, but being able to put yourself in the control owner perspective, put yourself in the process owner, the risk owner, their perspectives, and understand what they need from the data, what they can contribute, and really understand that it's from a relationship perspective of those risk elements, it's an end-to-end relationship, right? Everything from the training and the scripts that I mentioned before, inclusion of an incredible web of people and data, and don't lose sight of that and focus too much in one area.
Okay. Ivan, what's the advice that you would share?
I would say that continuing with the communication message is that as I said before, the internal control community in the organization should be in constant communication and very fluid relationship. And the other point will be investment in technology to help everybody to work much fluently and to have a proper data to go to this target that is the monitoring and not so focused on testing.
And Natish, I mean, from an organization as far-flung as Hsbc, the work that you've done is really quite remarkable. What advice do you have to share?
A couple of things I would say is, one is with the control testing, I think moving to continuous monitoring, I think it's important to not lose the experience, the expertise, the diligence that was done to move to a new framework. I think it needs to be thoughtful in how it's done. And obviously in a program where it's around risk management, the last thing we want to do is introduce exposure to the organization. So we don't want to increase the risk by trying to improve our risk management. So I think what I would say is learn from the experience done through control testing, but also run a parallel program. Until the continuous monitoring is fully embedded, whether that's 6 months, a year, it will take more work, but I would suggest that, and that's what we've done, which is continue the control testing as your continuous monitoring. I don't think it's not the best approach in my view of, January 1st, we're not doing control testing, we're starting continuous monitoring. I believe the importance of ensuring that we're not introducing risk by moving to this is best mitigated by having programs that overlap for a certain period of time, at least through each one of the controls are assessed from a continuous monitoring standpoint versus the control testing would be my recommendation.
Okay, thank you. Well, Ivan, Robert, Natish, you've really shared some great best practices and a lot to think about for us. I've heard you talk about governance, you've talked about transition, you've talked about the importance of people and communication, the importance and the interconnectedness of all of this data. It's a big job, and we're really grateful to all three of you for sharing your thoughts and perspectives. Thank you so much. Peter, back to you.
Thank you, Susan, and your panel for sharing such great insights on such a pertinent topic. Okay, so before we head to break, I just want to announce we do have some polls that'll be popping up on your screen. So as always, we are very interested in what you have to say, both our clients and our prospective clients. So please do answer the poll questions, and I'll come back later with the results. Always an interesting story. So right now, it's 11:13 on the East Coast. We're going to come back around 11:30 Eastern, so around about a 17-minute break. So polls, quick break, and then back at 11:30. Thank you so much. Welcome back. Hope you enjoyed the break. Okay, so next up, we've got a great panel discussion on Align to Thrive, integrating risk and compliance programs across the enterprise. So the panel will focus on building an integrated yet federated program to assess the evolving risk landscape, benefiting from integrated insights from operational, cyber, regulatory, infosec, and resilience and financial risks, and the role of evolving tech and analytics. I'd like to welcome Margaret Jesvaldi, Regional Vice President for the Americas East region from Metric.
Good morning. I'm Margaret Jesvaldi, and you're joining me from New York City. Good morning. I'm Margaret Jesvaldi. I'm very pleased today to be I'm Margaret Jesvaldi, and you're joining me from New York City. I'm very pleased to be hosting this panel today. Good morning. I'm Margaret Jesvaldi. I'm very pleased today to be We're experiencing a problem here. I'm very pleased to be hosting this panel today. Sorry for those. Hi, good morning. Sorry for those technical difficulties, everybody. Good morning, and thank you for joining Metric Stream. I'm based in New York City, and I'm very pleased to be hosting this panel discussion today, Align to Thrive, Integrating Risk and Compliance Across the Enterprise. And joining me today are three very distinguished guests. Joining me are Vishal Oberoi, who's a Managing Director and Chief Risk Officer for certain functions and all functions at Standard Chartered Bank Singapore. Vishal is the bank's Chief Risk Officer, covering compliance, risk, finance, and other functions. He provides extensive experience running programs of financial crime, compliance, business ops, operational risk, and regulatory change management. Vishal is a certified anti-money laundering specialist with 15 years of experience in various leadership roles for commercial, investment, and private banks globally. Prior to Standard Chartered, Vishal worked for Bank of America, Merrill Lynch, and Citi in both Hong Kong and New York City. Welcome, Vishal. Also joining me today are Marco Giunta. He is the country Chief Risk Officer for Zurich Insurance in Italy. In his role, he is responsible for a multitude of areas. After he graduated in economics and social sciences at Bocconi University in Milan, he started his professional career in investment banking in London at Deutsche Bank. Since 2008, he had been a management consultant, firstly at Oliver Wyman and later at the BCG Group. As a consultant, he led several projects in multiple fields, including strategic planning and M&A, innovation and digitization, capital and risk management for leading financial institutions and insurance companies in several European countries, including the UK, Germany, France, and Italy, Saudi Arabia, and South Africa. He is a graduate with honors of New York University. Also joining me is Richard Rolls. Richard is the Business Chief Risk Officer for Capital One, based in the UK. He's currently a member of the board and the Chief Business Risk Officer at Capital One in the UK. He's been involved in risk management since he started working as an auditor at PwC many years ago, and in his current role, he is the chair of the Assurance and Risk Committee, the executive lead for conduct and operational risk categories, and is a member of the Credit Committee and ACLO. He's responsible for the quality of risk management across Capital One's UK business. Good morning, good afternoon, and good evening, particularly to you, Vishal, where you're joining us pretty late in Singapore. Thank you very much, gentlemen, for joining us.
Thank you. Thank you, Margaret.
Thank you.
Okay. I'd like to start with a question where I'd like everyone's input here, and perhaps we could start with you, Richard. You know, in light of today's global public and economic crisis, and we've had a few months now to digest its impact from a lot of different perspectives, and in your role as a chief risk officer, can you share with us what are some of the lessons you've learned as you've looked at the risk management function? And as you look ahead, you know, what are you looking to refine?
So it's certainly been a crazy few months. I'll agree with you there. I think the key lessons, I think one of the most surprising things for me was how productivity has actually increased hugely in the kind of work from home emergency scenario we've been in. And I think that's reflected both our people's commitment to doing the right thing for our customers, and also the reduction of all of the commuting, those kind of things are non-value add. And so, you know, one of the lessons was actually people can work from home an awful lot, and you can still get great business and customer outcomes from that. I think that the flip side of that is this doesn't work for everyone. And so we've had to be incredibly flexible with people in terms of their own personal circumstances, you know, how it affects their mental health, what their home conditions are for working. And so, you know, we've seen from our people great productivity, but we've had to make exceptions and be, you know, kind of very nurturing of some people for whom this hasn't worked. And I think, you know, a lesson for me is the pace we've moved to get all of our agents at home, to get new risk management practices up and running, to improve our monitoring. So, you know, an immense learning in how agile we can be in a scenario that was rarely envisaged by kind of business continuity people. In terms of the things we're still working through, when to come back to more normal conditions, you know, balancing the impact on our customers, the impact on our people, reassuring them, plus the kind of long-term reduction in creativity and connection that remote working has, and actually how to enable more home future. Because to an extent, the genital people like working from home. It's got a great business outcome. And how do we, as a risk management function, make sure they can do that safely, and we don't put any risk for our customers or our data through doing that?
Well, thanks, Richard. I can attest that the level of collaboration here at MetricStream has been phenomenal in these times, and we certainly share a lot of what you just expressed right now. Marco, I'd love your perspective on the same question.
Yeah, no, fully agree with what has been said. I think that what I add in terms of lesson learned is how fast also traditional organizations can be in taking and in promoting changes. Generally, in our organization, things happen and change in months and years to get proper alignment, commitment, and so forth. But in this period, I think that many important changes in many organizations happened in few weeks, and I think this is an incredible lesson learned for the months ahead. The second point, I think, is very interlinked to this space of change, is how we can get rid of paper-based processes, which itself needs investment, of course, to change, but also creates difficulties as it is in terms of embedding control frameworks for risk and compliance. This is also what I believe we need to work from a risk management perspective to further refine our functions. First of all, we need to embed into the second line the same flexibility and capability to adapt to external conditions that we've seen in the business processes, in the distribution network, in head offices and so forth. We need to, as risk managers, to show the same type of flexibility, the same type of capability to adapt to evolving external conditions. The second point is around technology risk identification and management. I think the way we define operational risk, and we have operational risks in our mind, meaning manual errors, process failures, lack of 4S principles, and so forth, it is actually changing into digital failures, cyber risk, and so forth. And these events are accelerating these trends. I think we need to strengthen our capabilities also in the second line to deal with these new types of operational risks.
Thank you, Marco. You highlighted a lot of important points there. Really further, so many different points that are so important that we hear from a variety of our customers every day. The tighter integration between the first, second lines of defense. How do you further automate controls? How do you better synthesize and link data? There are a lot of challenges that are being discussed, and I appreciate your perspective in terms of what you're dealing with as far as challenges. Vishal, I'd love your perspective.
Thanks, Margaret. It's always great to go third because all the good points always get covered first, right? But no, I completely align with what Richard and Marco said. It really puts into perspective how global and how widespread this the pandemic itself is, of course, and the impact that it's having on various financial services institutions. I think the only point I would add is, from a lessons learned perspective, what we've seen in Standard Chartered is this is, of course, the ultimate acid test for our resilience framework. Resilience is a really interesting thing. You can build the most innovative, the most creative protocols, but it's only when it comes down to execution and when you actually require it, do you actually determine if it meets what you need. One of the biggest challenges that we've faced and we've tried to resolve as we've gone through the pandemic is the need for escalation of information and having the right information, the right metrics at the right time, and being presented to the right people. Obviously, during a crisis, one of the challenges an organization is faced with is the need to present data to senior forums, to the board, to management teams. But the question is, it's not about presenting lots and lots of comprehensive information. It's about presenting bite-sized facts and being able to get the right dashboards that are able to predict and tell you where the hotspots are and tell you exactly how you need to react to those and tackle the problems as you go along. The agility of our responses, to the point that Richard just made, the agility of our response has been absolutely top of mind, and it's almost, as we go through this, how do we build an effective playbook that will help us, not just in the medium term to deal with the crisis, but in the longer term if a crisis like this evolves. The biggest thing I think we've collectively learned as an industry is that pandemic risk is real. And it's not something that we can deal with on the fly. It's something we're going to have to deal with strategically and build into our framework as a risk management division, and not just here, but across the board with compliance, with technology, with all of our functions, and bring it all together so that we can collectively be a lot more resilient and a lot more sustainable in the longer term.
I would agree with you. Operational resilience is the key today, and a big part of that is really having the information and the right data in your hands pretty quickly. So I guess with those two key points in mind, what are you all doing as far as, I guess, what has your involvement been and what have the discussions been within your organization as you obviously look back and you have all these systems and you have disparate data, you have unstructured data, you have structured data. How are you bringing it all together in today's environment? I would assume that process has been accelerating pretty quickly. Richard?
It's certainly one of the most important things we've been looking at in a disparate. But I think we've always been good in certain risk categories where real-time monitoring is super important at a board level, such as credit risk. I think the more disparate things, such as operational risk, have perhaps been the poor relations, because they cover a lot broader suite of metrics and different organizational principles. But we've been working hard through our kind of centralized risk system to make sure we've got the right information at the right time, and that's certainly gone a little bit faster than we'd originally planned.
Thanks for that. Thanks for that, Richard. Marco, I'd like to get back to you with this question. Zurich Insurance has spoken about the fourth industrial revolution, which has caused the risk landscape to evolve at an unprecedented pace. And the revolution has heightened the dependency on interconnected technologies, business ecosystems, and economies and climates. So in such a dynamic and multifaceted environment, can you share some of the best practices that perhaps you're looking to roll out, or maybe that never were rolled out and now are being pushed throughout the organization, really to expand that peripheral view when you're looking at risk as a whole?
Yeah, not an easy one. The fourth industrial revolution technologies are, first of all, bringing, as you said, an unprecedented economic and social benefits to much of the global population. And this is the reason why we cannot let it fail. We need to make sure that the fourth industrial revolution succeeds. However, as I mentioned before, the fast-changing business and economic environment is not followed at the same speed by risk management practice evolution and adaptation. This is even more true in a context of, first of all, high fragmentation of sources of risks brought by billions and billions of devices at risk around the world. Two, a lack of widely accepted and agreed security standards around these technologies. And three, the development of what I call cybercrime as a service, as a growing business model with increasing sophistication tool, malicious services affordable to everyone. In this context, I believe that large organizations have very important responsibilities to manage these risks and to ensure overall success to these technologies. First of all, we need to push all together for global or at least widely accepted security standards. There cannot be compromises on investments on security, of course, but investments on securities can be scalable only through standard convergence. Second point is the retention of capabilities and skills within the organizations. In the past, waves of evolutions and technology innovation had brought organizations to outsource processes and skills. And while, of course, the fourth industrial revolution require to our companies to access to external knowledge, I believe that in this case, organizations must invest to grow internal capabilities and retain those already available in this space. And last but not least, I would mention the graduality, because of course, artificial intelligence, cloud services, Internet of Things, and so forth, they provide incredible benefits to organizations and most important, our clients. However, the pace of adoption must be in line with the capability to address, manage, identify these new risks. A staged approach supported by all the internal developments of processes and tools maybe is not in line with the business needs and pressure, but it creates the foundation for a sustainable transition to this technology, I believe.
Thank you, Marco. Thank you. Vishal, I'd like to digress to you for a second. And, we could take this topic and really talk about it all day. It's just so important. There's so many elements to it. But when you really sit back, Vishal, and in your role as a chief risk officer, what do you think are really some of the fundamental rethink and redesign questions, knowing what we're dealing with today? When you look at traditional risk, when you look at ERM, and tying this all in together and having it really integrated with compliance as well. What are some of those key things you're rethinking?
So it's a great question, Margaret. I think one of the first points would really be the acknowledgement that a rethink is required. And I think once a system and once an organization does that, then they're completely committed to it and bought into it. That's when great things happen, right? Otherwise, I think one of the existential challenges that many organizations will face at this point in time is they will tweak only relevant programs or what they consider to be relevant programs and not take it down to a fundamental level where we can actually make a tangible difference. The biggest starting point, I think, when you start doing that rethink and that redesign is don't expect to carry forward your old assumptions into the new normal. Yep. And what I mean by that is a lot of what went into the static design of your risk management framework and your target operating models has now drastically changed. Your dynamics have changed, your fundamentals have changed. So instead of just thinking about all the elements that went into what happened before and how to modify those, it's time to really, really go back to basics for organizations. In the previous panel, Natish spoke about the need for continuous monitoring. And I think that's a really, really important thing for us to ensure that you have a keep the lights on strategy that just is consistently there to make sure you're okay, and then you build on top of that. There are some really important factors that need to be considered, though, and I think one of the main things is that as a risk management and a compliance team, you need to now think about how are you going to do all of this remotely. And you have to think about it not just from the near and medium term perspective, but what is sustainable in the longer term? How much of this can you actually carry on? You have to again acknowledge that capacity is going to be at an absolute premium. You don't have the luxury of travel, and getting team meetings together and flying people down and actually organizing workshops. All of that is now virtual. So understanding that capacity is going to be at a premium, how do you ensure that you don't have any shortfalls with your overall risk management strategy? The two major elements of risk management, and this is even applicable to compliance, is that you're no longer looking at this as a static program. You need to be frequent in your risk assessment and need to be dynamic in that strategy as well. Do it more often and also leverage on automation instead of manual controls. I think collectively as an industry have realized that when push comes to shove, if you really need to deploy a digital transformation, you can. Look at us right now. We're all on a video conference, and many organizations have had to probably go through big programs of work. But when there was a need, we actually accelerated and delivered with agility. I think if we went with that same level of momentum, that same level of intensity towards automating our risks and our controls, we'd probably see a tremendous outcome. It's just that we probably need to commit to it, which kind of brings it back to the original point. If we acknowledge that we need to fundamentally rethink and redesign and bring together non-financial risk, let's say, across risk and compliance, that's truly when we start to get on the other side of this crisis, in my view.
Richard, any comments on that? Fundamental rethink and redesign.
I certainly think we do, and I think moving back to a regulatory perspective, I think the bar is shifting in a lot of theatres, less to a kind of tick box binary compliance and more to customer outcomes. And so, I think that certainly caused us to rethink quite wildly how we monitor and measure customer interactions, because just reading the right disclaimer is no longer acceptable from a regulatory and a customer perspective. You need to do more, and that's a super nuanced thing to identify and strengthen. And so you've really got to rethink how you test, how you monitor, how you train, as an example, to change that paradigm. And so I think I really agree with Vishal that we need.
Thank you, Richard. Marco, would you like to comment on that question, the fundamental rethink and redesign? I know you touched on some points.
No, absolutely. I think that we need to review that review our approach as risk managers towards the control environment and towards the business. I think going forward, also because the regulator is asking for it, our role should move out of our second line of defense room, let me say, and go into the business as consultants of the business, as support for the business. I think all the regulatory pressure that we are seeing is not because they want stronger risk management in terms of higher number of people or higher skills or number of resources per se, but because we are credibly seen in the market are those who can independently support some key changes required to our organizations. We can do it. We have the team for doing it. We need to go up and run, I would say. Hello?
Hi, gentlemen. I think we had a technical difficulty there. Very quickly, from a regulatory perspective, I think it's safe to assume perhaps the regulators took a pause at the height of the pandemic. What are you foreseeing now, and what are you anticipating in the next 6 to 12 months as some businesses are getting back to normal, particularly in Europe? Richard?
I think the regulators have been very helpful and pragmatic in almost taking the scrutiny off the kind of BAU stuff and helping, certainly in the UK, develop consistent forbearance programs for customers. Focus will be on the outcomes for those customers and what are the consequences. And I think the important thing for regulators to remember is this was all done under incredibly difficult circumstances. So, it has been impossible to train people in the way we would regularly train them to do some of this stuff because everyone was remote. And so, I don't expect for a moment there won't be errors in many firms because people have made mistakes in stuff that has been incredibly complex and rolled out incredibly quickly, and therefore I think there needs to be some level of understanding of that because it was a bit of a fire drill. But I think regulators will be moving to outcomes for customers who have been on forbearance programs, and also how you wean customers off forbearance into the mainstream collections processes when the kind of whiplash effect of the pandemic on the economy is going to start manifesting pretty quickly. We're already seeing broad swathes of layoffs around the UK, and whilst the furlough scheme has helped postpone that, it will hit. And therefore, how do you gear up your risk operations to support customers through that economic dislocation and coming off the kind of government-backed forbearance?
Thank you, Richard. I think I have time for one last comment. And Vishal, do you have anything you'd like to add there with your own set of regulatory requirements in the Asia-Pac region?
Yeah, very similar to what Richard just described. Regulators have been extremely collaborative and very understanding of the circumstances in which we operate. Of course, there was a need for transparency, and most organizations have been very transparent with the with what we're doing to tackle the crisis. There was a lot of sharing. There was a lot of and I think that what I think we appreciated the most is that we were given adequate space, because the regulators understood that we're all hands on deck right now. We need our capacity to tackle the crisis rather than to provide regulatory updates. So there was a very good structure and a very good rhythm to the way things were conducted. And I think it was something that the industry appreciated quite significantly. There, of course, going forward, it's critical that as we go through some of that fundamental redesign we spoke about, there is a need, and I'm sure all the regulators would like to see how we how we rethink our risk profile, and as a result, our risk appetite. What are the things that matter in the new normal? What are the things that actually make a difference as we go forward? So I think that's probably going to be an area of scrutiny and focus for quite some time.
Thank you, Vishal. I personally think we need to look at our regulators as a partner. I think sometimes we often view them too much as an adversary, and it's just food for thought. I think that whole concept needs to be rethought as well. I do have one question from the audience. I know we don't have a lot of time left, but I would like to ask it. And the question is as follows: what, in your view, are some of the best practices that enable collaboration across all lines of defense to ensure integrated assurance? Let's start with Marco. Would you like to take that one?
Yeah, absolutely.
Fantastic.
Absolutely. I think first of all, we need to have people in the control functions, in the assurance functions, who are business oriented and understands the business dynamics of our companies. So as long as we speak about frameworks, we don't speak about business. We cannot really collaborate. We speak about risk, compliance, or audit frameworks, and not about the business. But if we speak about the business, I think we go into the same direction. And second, more importantly, 360-degree objectives. We cannot work in silos, because with risk we finish here and then it starts compliance. I think a 360-degree view from our people and our team is what our organization needs the most.
Thank you, Marco. Vishal, what are your thoughts on that question?
It's a really great question, and something that I think a lot of organizations are grappling with. But I think one of the, if I had to summarize it, I'd say there's a need to build trust between the lines of defense. Each line of defense has its own purpose, and the criticality of the whole thing is that it's about making sure you play the role that your line of defense is built to play, instead of second guessing each other. We had the luxury of that in the old world, I think, because we had time, we had capacity to some extent. But in the new world, where agility is going to be the theme, we probably need to start playing those roles a lot more effectively, and truly use testing, use the third line and assurance testing purely for that purpose, to make sure we are focusing it on the right areas, and make sure that the first and the second line play more of their capacity and their roles.
I couldn't agree with you more, Vishal. And lastly, Richard, what are your thoughts regarding that question?
I mean, I think it is helpful to have a certain amount of tension between the three lines of defense. If everybody is completely aligned, then I think, I don't think you've got the right system there. But I think, risk management to me is all about good conversations. And so I think you need open, constructive conversations between the lines of defense. And I think you need a good committee at a very senior level in the business that can broker disagreements between what's acceptable and what's not acceptable. It's cascaded down, and so great conversations and someone to break the tie if they can't sort it out themselves.
Great points. Great points. Well, gentlemen, we are out of time. I thank you profoundly for joining us today, for joining me specifically today in all of your various geographies and time zones. It's certainly been a pleasure, and I wish you a great week. Thank you once again.
Thank you.
Thank you.
Thank you.
Take care.
Great. Thank you, Margaret, Richard, Marco, and Vishal, for your insights on integrating risk and compliance programs across the enterprise. So we have more polling questions coming up, so please be on the lookout for them on your screens. But next up, we have a customer case study on transforming GRC at the Nationwide Building Society in the UK. I'd like to invite Nami Ingorani, Senior Director at MetricStream, to host this session. Nami, over to you.
Thank you, Peter. Good afternoon, good morning, good evening, everyone. I'd love to welcome Simon Cory today, Director of Risk Strategy at Nationwide Building Society. As Director of Risk Strategy at Nationwide, Simon is responsible for the organization's risk framework, risk systems, and for managing the CRO's office. He was recognized as MetricStream GRC Practice Leader at the 2019 London Summit and was named Risk Manager of the Year, and his team were named Team of the Year at the 2019 Risk Management Awards. Simon has worked for Nationwide for approximately 20 years in a variety of roles across first and second line risk, finance, and transformation functions. Before working for Nationwide, he performed finance and risk roles at Legal & General, Standard Chartered, and AXA, having qualified as a chartered accountant with PricewaterhouseCoopers. He leads on the Risk People agenda and chairs the Risk Inclusion Committee. Outside of work, Simon is married with 2 sons, loves watching Welsh and his 2 sons' rugby teams, music, and holidays. Welcome, Simon.
Thank you very much, Nami. Very comprehensive introduction. Thank you. So thank you to everyone for joining. I'm going to talk about Nationwide Building Society's transformation journey in the GRC space. What I'll start by doing is just telling you a little bit about Nationwide Building Societies, particularly for those who aren't based in the UK. I'll tell you a bit about the risk function in the society, and then go on to talk about our transformation journey. So firstly, Nationwide Building Society. So Nationwide Building Society has been in existence for circa 170, 180 years, and was formed to fund home building, and that was financed by retail savings. So essentially, customers provided retail savings to the organization. The organization then lent that on to people to build homes. So if we can move on to the first slide, it'll talk about this in a bit more detail. And essentially, our purpose hasn't changed over the years. We now take in lots of retail savings and lend them on to people lend them on in the form of mortgages so that people can buy their own homes. Sometimes they're self-built. Other times they're just buying them on the high street as usual. Over the years, we've expanded our product set and now include current account, credit card, and personal loans. So essentially, we are a mainline banking provider here in the UK. Our balance sheet is £250 billion UK pounds in size, which is circa $290 in size. We've got 16 million customers in the UK, 700 branches, 18,000 employees, and we're recognised as being number 1 for UK customer service on the banking on the high street for banking. So we're a major player in the UK, systemically important, but we're UK centric. Importantly, our ownership structure is different from most banks. We are owned by our customers. If you have deposits with Nationwide or you are a mortgage holder with Nationwide, you are one of our owners. We don't have shareholders. You are one of our owners. And as a result, we choose to price more keenly than our competitors. Our margin, therefore, is smaller than our competitors, but that's because we pass pricing benefit back to our customers through our ownership model. So that's a little bit about Nationwide Building Society in the UK. In terms of risk management in Nationwide, as a result of being owned by our customers, we are very prudent. We have prudent capital ratios, liquidity and funding positions. Our credit risk exposures are very, very good and low compared to our banking peers. We have limited regulator enforcement. We have a good relationship with the regulator and are seen as being a good, safe organisation here in the UK. We have low levels of losses, and from a risk management perspective, risk management is strong in society. We have a large first line set of teams dispersed across our organisational community structure. So they are spread across the whole of the firm. Probably about 1,000 people work in our first line teams across Nationwide. So fairly large team. The CRO has responsibility for first line credit risk in addition, and also fraud and AML, which are first line functions, and the second line oversight team. The second line oversight team is much slimmer than first line, obviously. They're roughly about 100 people in the oversight teams. So that's a little bit about risk management and Nationwide, and a little bit about the context. So if we could flip on to the next slide, please. This will now talk a bit more about our GRC program, which is the main order of the day, obviously. So going back 2 or 3 years ago, I identified as Director of Risk Strategy the need for new GRC technology. We embarked on a program to improve and simplify our risk management framework in the organization, and wanted to improve our technology that went alongside that. The main drivers for that, and essentially the reasons for giving the funding that the organization gave us funding is really shown here. So we looked to articulate that we needed to harden the control environment. Now, this was a difficult message, given that our losses are low and the Nationwide manages its risks very prudently. I essentially had to say to the board and to the leadership team that we needed to improve in this space. And the story there is one of saying that we understood in pockets how our controls operated. We didn't understand holistically how our controls operated. And actually, I knew that we were behind our peer group in that, and we needed to improve. So hardening the control environment was the first driver. Our legacy GRC tool was hard to use, and our users didn't like using it. Therefore, it was hard for them to get data into the system. It was hard for them to get data out of the system. And that led to them essentially having two big teams just really designed to administer the old legacy system. So that was part of our business case. Importantly, we didn't build in cost savings into our business case. What we did build in, though, was improved capability, and said that if we were to be able to progress with the GRC technology, we'd be looking to get the organization to mature its understanding of controls and potentially realign those resources to the management of controls, to remediating controls, and to managing the controls agenda more broadly, rather than administering the old system. The final element which we brought out was that we had an end-of-life, heavily customized legacy system. The predecessor system was put in about 5 years ago. It was customized very, very significantly, and really customized to align with our framework. So if we were to upgrade it, which we needed to do because it had come to the end of its service life, we would essentially have had to put in, it would be a whole new implementation. So instead of upgrading our previous system, we went back out to market and to see what competitors were available, and then looked to put in the best fit for Nationwide. So that was around the need for GRC technology. The implementation practices are, these are really important actually, and we went live in February of this year. And as a result of these implementation practices, I would say that we have seen the benefits which we were hoping to, which are shown at the bottom of the slide here. So the implementation practices, we were really clear, having learned the lessons of the previous implementation, to not to customize the system at all. We looked to configure, not customize, and that was our mantra from day one, and we managed to achieve that. And we chose to, through implementing the new GRC technology, to, if necessary, change our risk framework to align with the system rather than the other way around. The legacy system, the opposite was true. And as a result, we ended up with a heavily customized system that was very difficult to use and very difficult to upgrade. So here we essentially said to ourselves, what we would do is, if the system had been designed and was being used by our peers successfully, we should be able to realign our framework and not impose the Nationwide way onto the system, which is a new way of working actually, and certainly will stand us in good stead as we look to upgrade into the future. We spent a lot of time engaging with our stakeholders. So we identified business champions to put into those first line teams that I talked about earlier on, the team that has roughly about 1,000 people across Nationwide in it. We looked to put in business champions into individual teams who could act as local ambassadors for the GRC technology program, and would be local owners who effectively had to engage with their own people locally, had to enthuse their own people locally, and engage back with us in the central program team to ensure that we were listening to our stakeholders. So the appointment of business champions was a differentiator compared to the previous implementation, certainly, and was successful for us. We had a series of user engagement events, and speaking to, so we worked alongside KPMG on the implementation, speaking to them and also to the metric stream team. I think this was, our approach here was fairly unique. We, every quarter, we took our users, all of whom were probably about 400, 500 people, off-site for half a day or a day to a local hotel in Swindon in the days when you could actually get lots of people into a room, which you can't nowadays. And we engaged them, we showed them the technology, we talked them through the journey we were on, and explained to them, importantly, why we were doing what we were doing. And really, we wanted to take them with us. In some ways, they didn't like the old system, so they were pretty receptive to start off with. However, in designing a new system, they wanted to feel engaged and feel that they'd been able to play a part in shaping it. So the engagement events were designed to be two-way, to listen to their wants and needs and desires, to get them to get their hands on beta versions of the technology when we built it, to engage them in competitions, and they could win various bits of merchandise and all that sort of thing. Just to engage them and just to get them a bit excited. So that was a really, they were a good series of events which helped us to engage with our stakeholder group. We had a series of configuration workshops as well with a smaller set of first line users to help them to feel that they were being heard effectively, and also to get them to endorse our approach. What they didn't do, importantly, was really help to shape the system too hard, because we stuck to this out of the box zero customization approach. Really, the conversations we needed to have with them were around configuration. What would the organization structure need to look like, for example? We wanted to take them through, well, this is what the risk taxonomy will be, which we'll put into the system, and this is what the controls taxonomy will be, and so on, so that they felt they were being heard. But really, we were telling them what we were doing rather than asking them what we needed to do. And again, that was different to the previous implementation, which really, in hindsight, I was in the first line at that time. The previous implementation was a system designed by a committee, and as a result, it struggled from day one. We spent some time with the regulators in the UK and also with the C-suite in Nationwide Building Society to show them the tool, to show them the technology. And actually, we engaged with the regulator really effectively and possibly a little bit too hard, because they started holding us to account for delivery of the project. I mean, in many respects, it was very helpful to me, sat in the centre in the project, to ensure that we maintained traction and that we couldn't push our dates to the right. Certainly, our first line stakeholders, I think, if you'd given them the choice, they would have looked to go live later than actually we managed to. And the regulators' interest managed to hold our feet to the fire and keep us to the original dates. So that was very helpful, actually. And as I say, in some ways, we got them a bit too engaged because they were holding us to account to achieve the dates. But from a program delivery perspective, that was good. And it meant that we didn't have as much optionality as the first line teams would have wanted us to have around when to deliver. So engagement, it was vitally important, and certainly me and a lady who works for me, Sarah Harmon, who's spoken at these events before, we spent an awful lot of our time doing that, and I spent a lot of my time with the C-suite, talking them through what we needed to do. Certainly in advance of getting funding, I went around and spoke to all of the funding board and spent a long time with them explaining what we were looking to do and why we needed to get funding, and it absolutely paid off. The final thing we took into account was understanding the industry approach. So KPMG supported us, as I said. We also built relationships with our UK banking peers, and some of them through the summits and other contacts we've got, to make sure that what we were doing was consistent with the industry and was not a Rolls-Royce solution designed by Nationwide and was overcomplicated. We were able to use that quite a lot, actually, particularly with C-suite, to say we know that the UK banking peer group are doing it in this way. If it works for them, it should work for us. So that was something that was really helpful, and KPMG helped to give us visibility of our peers' performance as well, which was helpful. And those implementation practices have really led to the benefits of having a single source of the truth, having one version of risk and control and loss data that's linked to processes, linked to suppliers, linked to a number of different data items. And that's been fantastic. As a result of those implementation practices, we've achieved what we set out to achieve. We've got visibility of control gaps, and this was something which, as I said earlier on, we didn't have holistically, we didn't have for the society. one place where you could go to understand the performance of controls, whether they've been designed adequately or whether they're operating correctly. And we found since implementation back in February that the board in particular and our chief executive have focused on this pretty hard. We've had 2 all-society off-site events where our chief executive has stood up, has talked about metric stream, the implementation of metric stream in the society, what it's looking to drive. He's actually dragged out some data points from the system himself and talked about, this is the number of untested controls we have in the society today. That's unacceptable. We need to reduce that as close to zero as we can do. We need to have a plan to get to that point. And importantly, then we need to focus on remediation. That's where the value add comes. So we wouldn't have been able to do that without metric stream. And so that has been fantastic for us. And the data integrity, the fact that you can only put certain items into the tool and there are certain fields that if you don't complete them correctly, you can't get your data into the system, has been fantastic because it makes sure that the data model is absolutely robust. So we've seen the benefits we were hoping to see as a result, really, of the implementation practices, which I'll just circle back to conclude. Zero customization. No customization, configuration yes, customization no, out of the box and no customization has been fantastic for us, and I'm really optimistic will help us as we look to upgrade into the future. The engagement through business champions, user events, the regulators, C-suite demonstrations, all of them were vitally important, and understanding how our peers are operating, understanding the industry approach. That's helped us to design a system which we know benchmarks well against our peers, and we know is going to do exactly what we set out to achieve. So I'll finish there, Nami, and I'll pass back to you. If we've got any questions coming through, or if you've got some questions you want to ask me, I'll let you move to that page now.
Okay. Thanks so much, Simon. And I think some great learnings from the nationwide case study for anyone who's on the GRC journey. So I think we do have some questions from the audience, if we could just get those on the screen. Great. So Simon, a question for you. What is the biggest value you have achieved so far in your GRC journey? And what do you anticipate in the future?
Thank you. I think the biggest value has been the certainly having an enterprise view across the full risk data set that includes risks, controls, the loss events, being able to tie them all together. I mean, we are really just at the start, I think, of understanding the power of all of that. We've taken some reporting through to risk committees and so on for the first time in the last month or so, and shone a light for the first time on the controls data in particular, where there are gaps, where we need to prioritize our testing program. And that has been not transparent to us before. And the organization has not been able to prioritize which controls to test. In the past, we've had a whole set of individual teams who've been trying to do that in isolation, and who've looked at their own particular controls and have been able to explain to the regulators how they're doing their jobs well and how they understand that their environment is being controlled adequately. What the chief risk officer and the chief exec and the board have not been able to do is to join all of that up and say with confidence we understand how our controls are operating and where our gaps are. So I think the real value has been in drawing together that data set for the first time. I think the real value that we will look to achieve with that in the future will come through looking to get testing plans in place, be really sure about how those plans are being prioritized, but importantly, how controls gaps are being optimized, how controls gaps are being remediated, and potentially some controls could be switched off because we'll have visibility of how other controls are operating across the individual risks. Therefore, there's no need for those additional controls. So the improved maturity that will give us, I think, will be the real value add from this.
Thank you, Simon. Do we have another question from the audience as well? Okay, so I think that was it from the questions. Thank you very much, Simon. Again, I think every time I hear a case study from a client, and I know I've been involved with Nationwide, I think it's just great learnings and just so much you can take away and sort of utilize in your own GRC journey. So thank you again for spending the time with us. Thanks, everyone.
My pleasure.
Great. Thank you, Simon, for sharing Nationwide's story with us. That was pretty inspirational, something we all look to achieve in our GRC journeys. Okay, so next we have a panel discussion on optimizing compliance programs in a dynamic and distributed business. So this discussion will focus on navigating the dynamic and complex regulatory landscape, regulatory change applicability and impact assessment, effective policy governance, and how to strengthen regulatory relationships. So before we do that, I want to announce we have another polling question, so please take a few seconds to read and respond to that. And I'd now like to introduce Anand Mazzoni, MD and GM for the UK and Ireland business at MetricStream, to moderate this session. Anna, over to you.
Welcome, everyone. We've got a very exciting panel discussion lined up for you in this next session. And the title of our panel discussion is how we're going to optimize, or how these compliance leaders are optimizing their compliance programs in a very dynamic and distributed business environment. So with us today, I'll introduce the panelists, are John Robbins, who's our Chief Compliance Officer from the Intercontinental Exchange, ICE. We also have Elizabeth Escoya, who is Head of Compliance at Bank de Group Petercam, which is a private bank in Europe, and she's based in Spain. And we have Hernan Huweiler, who's head of supplier due diligence in the compliance strategy and the procurement center of excellence for Danske Bank. So what I'd like to do is we're going to have each of the panelists answer a question related to their compliance programs. And we're going to start with John. Hi, John.
Hi. Thanks very much.
Sure, absolutely. So let me read out the question and then I'll turn it over to you for answer. One of the core issues facing banking and other institutions today is the amount of regulatory compliance and adapting your risk management models to this shifting environment. So, for example, in the current scenario, we know that compliance professionals are having to manage really many different types of compliance risk. So, the first question I have is, what do you see as the top risk that compliance professionals are focusing on? And then, for the second question is, what are some of the best practices or the tools or operating practices that you would recommend to our audience in order to manage these types of compliance risk?
Great. Again, thanks very much for inviting me. And this is an age-old question about what are the top risks or what keeps compliance officers up at night. And I would reasonably suggest those things that keep us up at night right now might be somewhat different from those things that kept us up at night 6 months ago. Certainly the pandemic has created a remarkable work, business, and regulatory environment that has really shifted how our risk profiles directly apply to our day-to-day business practices. And compliance programs around the world, including ours, have had to adapt to different characteristics of employees, system impacts, market impacts, all of it, and it needs to be combined in a very thoughtful, real-time, and pragmatic approach to ensure that we can prevent significant regulatory problems or issues. So, hitting to the question, I'm going to say that one of the predominant risks that compliance organizations face in today's environment, irrespective of the pandemic, is in regard to the interactions and or the connectedness between different regulatory environments. So certainly in our organization, we have a multiple of different business activities. We have certain business activities are highly regulated, some are less regulated, and one of our unique challenges is interpreting the applicable laws, rules, and regulations and coming up with and applying a pragmatic risk and control and compliance framework that meets those different regulatory expectations, industry expectations, and client expectations, and does so in a way where compliance is supporting the business to sustainable profitability. And I'd say that finding that balance is certainly a unique challenge and one of the critical risks that compliance organizations face. Certainly in connection to the pandemic, other critical risks really relate to managing employee issues, the fact that employees are now predominantly working from home, or many are, and we have other offices where employees are coming back into the office. That disparity of work function requires a different level of surveillance and oversight. It's also created new opportunities for conflicts of interest, and our systems, policies, practices, and procedures need to manage those. And then finally, some of the significant market impacts and the impacts to our vendors and impacts to our clients have affected how compliance interacts with these different systems and how we surveil and monitor and manage these different activities. And so these are the things that are keeping me very focused, keeping our team very focused. Some of the best practices that we've employed or that we feel that we've identified and really leveraged from a number of our clients, a number of our industry peers, are really around building a coordinated set of practices through shared understanding of those risks with our business. So certainly it's important to have a very, very clearly identified first and second line of defense. And ICE's and the business activities in which I directly oversee, we've gone to lengths to really make sure that we've got clean and clear lines of demarcation. And with those lines, we have then really embarked on a series of working groups and task force groups to make sure that we have business understanding of these critical risks and critical business practices for which we have some ongoing monitoring and concerns. So what I mean by that is, instead of compliance simply monitoring business practice in a traditional sense, we've really worked hard to partner with the business to ensure we all are on the same page around these shared risks, ensuring that there's shared understanding of these risks, and from that, kind of building cross-functional teams and practices to make sure that we've inventoried those risks in a pragmatic way.
Oh, thank you, John. So I'm just curious, before we go on to the next question, Elizabeth or Hernan, do you have any comments on John's response to the questions? Anything that maybe Danska or Banco Group is doing differently than what ICE is doing?
Well, in our case, it's something similar. We have learned, or we are learning, that we need to change the classic way of focusing and the usual way to treat a risk, because the environment has changed, and we need to focus in a different way, working in different manners, and also to look for different kind of supports, because people, I think that and teams are the main important perhaps in that moment to be successful in our individual goals.
Thank you, Elizabeth. So, Hernan, maybe I'll move to you and we could take up your question. So the question that Hernan was considering is the current crisis scenario has further demonstrated how critical due diligence to identify and manage multiple supplier risk scenarios is required. And businesses are seeing greater visibility and resilience, or seeking greater, I should say, visibility and resilience into their supplier network so they can move more thoroughly in assessing and mitigating supply chain risk. What are some of the initiatives within Danske that you've seen being put in place during this pandemic that have enabled you guys to manage your supplier operational risk and resilience?
Thank you, Anna. This is a very relevant question where we are addressing the third-party risk in our compliance program and how we can adjust the initiative to the new normal and the recovery of different services after the shutdowns and most of the crisis. Let me share some of the tips that we are using in order to address the new environment and the new configuration of systems. I recommend to use a very wide definition of third parties to identify all the risks in the supply chain and also in the partnership that we have, joint ventures, also covering the fourth and fifth parties, focusing on the essential suppliers, the outsourcing service providers, and also linking all these third parties to each geography, what is going on. The different countries, the different regions had different risks and different requirements and different situations in the face that they are dealing with coronavirus. Now it's not the same to try to look for a global standard when you got China in one stage and then you got Denmark in another stage and the US in another stage in how they face the crisis. Also, when we are talking about risk management and compliance, we need to prepare for incidents. And we need to request our third parties to communicate any risk in advance in order to agree what we want to do with the business plans and the business continuity plans. Also engaging the employees of vendors and subcontractors with the new safety and operational requirements and the new protocols that we have. Very important also in my area is how we reinforce the due diligence and the ongoing due diligence, and particularly how we are enforcing exit plans. Look for alternative, different suppliers, different logistic channels, focus on the supplier that they are in high demand now in order to get a better agreement. Another thing that we are covering in terms of dealing with those risks is monitoring the solvency and the dependency on a single supplier, particularly when we are talking about concentration risk, whether we are really dependent on a critical project, very strategic thing on one supplier. Is extremely important that we are enforcing the right controls, the right contract clauses, in working in a direction, particularly when we see that there is a risk for invoking force majeure clauses, trying to maintain the contracts, trying to renegotiate, and also other consideration that I want to recommend is how important it is to digitalize the way that we are dealing with the compliance program, the requirements, while everybody's working from home, everybody's working on the recovery. So it's extremely important to get access to the documentation, to the SARS to pay tools, to the really go and do a very deeper review about what is going on and the monitoring. Because we need to prepare. We need to prepare for a scenario of the economic crisis after the coronavirus, in which I foresee that it's going to be higher fraud risk and corruption risk all around.
So if you're expecting there to be higher fraud and corruption risk with the third parties and potentially fourth and fifth parties, how do you manage how's Danske managing that with their third parties? Can you elaborate on that a bit?
Absolutely. As Sean said, that we need to monitor conflict of interest and the activities and how we are supervising the employees in working from home. And it's extremely important that we had the right red flags when we see and we foresee that there is an unusual transaction. We had a lot of tools from machine learning to business intelligence that can simplify the way that we are collecting those red flags to be timely received in the cell phone, saying that there is a new risk here, and let's address that particular transaction when we think that there is a fraud, a collusion, or a corruption risk.
Thank you, Anand. So some of the things that you talked about in terms of getting your third parties to communicate risk and kind of reinforcing these due diligence and monitoring different types of risk, like fraud risk, also solvency risk. I'm just wondering if John or Elizabeth have any comments on what Hernan said.
I'm not sure I heard all of your questions perfectly. The phone, it broke up a little bit on my end, but I think that if I'm correct, your question was, are we doing things differently than what Hernan indicated regarding fraud and different types of vendor risk?
Differently or?
So we have a centralized vendor management oversight program, and I would suggest that we're not doing things differently materially. One of the things that we do have is a risk profile attached to different vendors, for which we then employ different strategies for different vendor types. So some vendor management oversight is on site, some of that is through a series of questionnaires plus on site and so forth. To Hernan's critical comments regarding conflicts of interest, I think that that's a singularly important area for us to focus, really in trying to identify where there may be unique conflicts of interest that we never really thought about in prior work environments or prior business environments. I think that that's one of the challenges that compliance and risk programs have, is to really be proactive, not to simply measure and manage to existing laws, rules, and regulations, but to be looking to identify new areas where there could be potential issues that the regulators haven't yet identified. And so a big part of our effort is to, again, collaborate with the business and really try to understand how they're interacting with these vendors so that we can identify new red flags or new issues that might become red flags to help us avoid that risk proactively.
Great. Thank you, John. Apologies on the audio disturbance there earlier. But Elizabeth, did you have any comments that you wanted to make on Hernan's response regarding third parties?
Nothing else, because I'm on the same way of thinking. So I think that we need to adjust in that way and be sure that not only regulations are the top of our schema in order to develop the compliance function in our entities.
So why don't we move to you then, Elizabeth, for your question. So we've acknowledged that the current situation with the pandemic has put a lot of focus on the GRC professionals' role and the expectations that compliance and risk professionals have to deliver to the business units, to the ExCo, to the board, are slightly shifting. So I would like you to comment on what are some of the measures that GRC leaders in the financial institutions as well as in corporates, what do you think they can do to improve operational resilience and serve customers and stakeholders now as well as into the future?
Well, first of all, I think that the current situations that places great emphasis on compliance, risk, and governance professionals is because three main issues. The first one is the coronavirus pandemic situation that we are living. Also, I think that the conclusions reached by the European Securities and Markets Authorities, ESMA, on the outcome of the implementation of MiFID II have led it to rethink the compliance functions. And the third one, the large volume of regulations and legal requirement in which we are involved. I am sure that DAC 6, GDPR, MiFID II sounds very familiar to all of us. So if I talk in the two first ones, it's clear that it's in a crisis situations that companies must demonstrate that they are prepared to face the contingencies that may arise. And COVID-19 has made us reconsider our compliance programs, and it has obliged to make a quick and different risk assessment adapted to the new environment, as John said at the beginning. For example, in Spain, last 4th March, government has declared alarm status for all the countries, and many questions arise for compliance and risk teams. How our procedures will be impacted in these new circumstances. For example, which procedures should be reviewed, how many will remain, how many will be redone. Is our risk map impacted by this new situation? New risks appears, different impact in the existing ones. What about our controls? Are they enough? Do they need to be changed? Do you need new ones? Is our compliance ready to be adapted in a very brief short time? Is this flexible enough? So the application of new measures are still working, as Herman said before, with the aim of guaranteeing the health of kids, for example, requires a certain act we carry out to ensure with the health crisis has its that's taking place means that the authorities are dictating a series of rules and recommendations that must be implemented and supervised with the company. The fact that the companies have surveillance and control measures as a compliance program, for example, that are suitable for preventing crimes or significantly reducing the risk of their commission prior to the crisis will make the response to it faster and more likely to succeed, as we will be prepared to identify and control the risk of the organization and to implement more quickly the new measures that pandemic situation advises and to which we are obliged as a result of the measure taken by the authorities. It is equally important that we make sure that we record all the actions taken during these situations to guarantee documentary evidence that may help us in the future to demonstrate our maximum commitment to compliance with the rules and legality in eventual criminal procedure against company. So it's not only the rules, it's something more that is behind that. In view of these extraordinary circumstances, the compliance programs understood as the set of internal rules, procedures whose purpose is to prevent, manage, and control the risk to which the company is exposed, are set up as allies when it comes to facing the mitigating the effects of the crisis. The way in which the company managed this unexpected situation from a defensive perspective or also a proactive, trying to anticipate and cushion the potential impact of the crisis on the brand, constitute a decisive factor for the sustainability and continuity of the business in the future. The same applies to the development of contingency, action or business continuity plan and the speed with which the appropriate measures are implemented. For example, in our case, we have to implement a business continuity plan, and it was the first time that we need to do it. And we realized that not all the circumstances around the coronavirus were included in our. The assessment of financial measures anticipation of the response to a second wave of the pandemic will be a key element in the management of the crisis. So compliance is no longer a trend, but is a necessity, is something that we need, which highlights the company's desire to create a framework of protection in exceptional situations to increase the confidence of the market, customers and suppliers, and safety among its workers. Is the third party that Herman was talking before. All this shows that high degree of business compliance and commitment to a new scenario that is emerging at that moment. The second issue that I mentioned was the ESMA guidelines that adapts the requirements of compliance function to MiFID II, and it push us to be in the focus too, because our roles, our responsibilities, our tasks has been a little bit changed. Some of them are still persisting, but another one has been changed. Entities should periodically review their risk map to ensure that compliance functions approach and oversight activities remain valid and that there is no additional risk that has been arised to the changes in the regulatory framework, new business areas, or other relevant charges in the entity's organizational structure. So it's something that is a little, perhaps, bit larger than it was. The purpose of the risk-based oversight program should be to assess whether the entity is conducting its activity in compliance with the obligations of MiFID II, and whether its internal policies and procedures and organizational controls measures remain effective and adequate to ensure the compliance risk is properly monitored. It's true that it's a focus for a financial sector because these regular sectors has defined the figure and the role, and it's very specific the way that the regulators ask us to develop our function. That's why it's our guidelines that we use in order to implement and develop the function. These guidelines also define the content to be covered by mandatory compliance reporting and include in their scope all business units involved in the provision of the investment services, activities, and ancillary services. So it means, again, the scope is quite bigger. The important thing, under my point of view, is that the advisory and support responsibility are areas of compliance function that include especially promoting a culture of compliance throughout the entity, a continuing training or education, and a supervision of the staff providing investment services in collaboration with the management team to determine whether the entity's policies and procedures are properly implemented. They are also attributed to the compliance function the obligation to participate in the development and review of policies and procedures, in particular remuneration and product governance policies. That is quite important in our entities, and also the obligation to advise business units on all strategic decisions on new business models, among others. So this is an example that is not just to follow the rule or how to describe a procedure in order to be aligned with the rule. It goes further because it implies to take decisions, it implies to be involved in the business. Sometimes it's not very usual to understand compliance risk or these control areas as a part of the business. So I think that is a big change in that sense. It is also clarified that entities must ensure the compliance function is involved in communications with competent authorities. There's nothing new. All significant changes to the organization, including approval of new business line and new financial products, that is business clearly, and the definition of staff remuneration policies. There is a big change that I think it's important to mention, that the entity must have the necessary resources and mechanisms appropriate to the scale that it's normal, but in relation to the adequacy of the human resources that are developing this function, a minimum periodicity of 1 year is set for the management of the entity to verify whether the staff and their expertise remain adequate to carry out the obligations of these functions. So it's something that is quite new. final guidelines also prohibited the combination of the compliance function with internal audit functions. In some organizations, sometimes it's difficult to draw a line between risk function, compliance, audit. Even we are talking about second line or third line, sometimes it's a little bit mixed, and it needs to define correctly responsibilities and tasks, perhaps more in a small entities than in big one, but it's possible that happen. And finally, there is no mention in the final version of these guidelines of the implementation of a dedicated MiFID II compliance team. That is something that was in the draft. Always responsibility for compliance function always lies with the entity, even if the function are outsourced in the whole or in a part. And competent authorities should assess how entities plan to meet, implement, and maintain the requirements of the compliance functions. This is also a new point that is important to know, that the regulators could come home and ask what are we thinking, what we have planned to do in this kind of functions. This includes, for example, the exercise carried out by some competent authorities in the union countries, which consist on having the compliance function of entities reflected in a questionnaire on the exercise of supervision carried out and sent to the regulator every year. So it means that the focus is in that area. You asked me about the stakeholders and how can we do in order to fulfill their expectations. Well, stakeholders know the importance of corporate compliance to a company's success. Properly measuring a stakeholder expectation can help ensure that compliance efforts are satisfactory to the company by adding value. Some of the tasks on the agenda of the officer today, the situation I've talked before, and this new next future that we are going to have, the analysis of the new applicable regulation, identification of new risks, categorization of responsibilities, definition of roles within the organization. We need to rethink a lot of things that we have done during the last years, planning new procedures, implementation of measures to ensure and protect against possible cyber attacks, and many things that could be nowadays in action plan. Some of the aspects on which I think we should focus our efforts to achieve our goal. Well, for me, it's important resources, human, economic, and technical, and the stakeholders and also the direction should be aligned with that. Talented people is a must. A budget to cover the needs compliance, and a simple and a strength compliance system program that helps us to run this way. Training also important for people in the entity and also for the compliance officer. Planification, compliance culture. At last but not least, be always proactive if it's possible and reactive when it is necessary. I think that could be a sentence that summarizes a little bit what is the situation that we have at this moment from compliance side.
Thank you, Elizabeth. That's a very comprehensive answer, and you really gave us a lot to think about there. I know we've only got about 12 minutes left, and I thought that I would ask each of you to comment, because on one question that I have, because you each come from different types of organizations, obviously with, this a compliance kind of requirement in your particular roles. But, given where we are in the pandemic, I think the audience would be interested to learn what have you, or what would you say your organization has learned as a result of being in the pandemic, from a regulatory compliance perspective? What is it that, I heard, for example, got to liaise more with the business, and I have talked to obviously some of your peers in the market, and they talk about the fact that, because of the pandemic, silos started breaking down very quickly, and we started working together. more, but I'd be curious the audience, I think, will be curious to hear from you as to what have your learnings, what did your organization learn from the pandemic regarding regulatory compliance? John, let's start with you.
I'll try to be very brief. We've got a very structured program to assess the impact of laws, rules, and regulations on our business activities. I would say one of the things that we've learned in respect to current and proposed rulemaking is the importance of coordination and collaboration with our clients and other key stakeholders. And so I think more than ever, it's important for us to understand how changes to the regulatory climate is not only affecting us, but affecting our peers, affecting our vendors, and from there, looking to coordinate our risk and compliance program oversight to not only meet what might be termed as a literal interpretation of a regulatory expectation, but a more pragmatic kind of industry perspective, so that we can accommodate where our clients might be concerned, where our peers are being affected, where our competitors are being affected, to make sure that our compliance program is really both pragmatic and kind of proactively driven to meet a regulatory climate shift.
Thank you, John. Hernan, what can you say from Danska's perspective? What have been the learnings from this crisis?
In the response to coronavirus, we learned how important it is to have a crisis committee, that they are following a protocol that we were able to test, that we were able to train, and having the holistic view of all the impacts, all the risks, from procurement to compliance to physical security to, of course, business continuity plans, and having at the group level and also in the different subsidiaries, these committees can centralize the decision making, can improve the communication, can guide the employees in order to address questions and subcontractors and vendors and third parties in general, to get only one answer when the crisis was impacting the processes very deeply. And in the way that we need to prepare those crisis protocols, it's very important that we develop the network of ambassadors of compliance, ambassadors of risk management in each of the subsidiary, each of the business line, even each of the building. We need to articulate the muscle to go directly to the sites and be able to see our ears, eyes, and hands in different locations when there is no time for updating a policy, when there is no time for creating a compliance awareness campaign. We need to be fast, and having a compliance network with different ambassadors that they can take the leadership on site is extremely important and part of the resilience that I think that many organizations learned during the crisis.
Thank you, Hernan. And Elizabeth, we have a few minutes. What would you say are like one or two learnings that your firm has gotten from the pandemic?
Well, internally, we have learned that we have been able to react as quick as necessary to be prepared to affront the situation. We have been able to work from home, the 100% of the staff in 3 days. So it's something that for the company previously we cannot imagine. We will try to do our best, but at the end, in a very few days, we will be able to do that in perfect conditions. And so we feel comfortable that we realize that we have the base, the necessary base to build something on and be able to go on with our business. And in the client side, we realize that the relationship that we have been established with them has been even be stronger, because was very easy to understand their needs and not much difficult to offer the solutions that they have. Even the market has a lot of volatility, so we need also to explain very well what was happening, the strategy that we implement in the portfolios, and we see that there was be a very good synchrony with the client in this situation. Apart from that, we have noticed also some aspects that we could improve. We have learned that sometimes we need to be perhaps better prepared in some aspects, and we take note of that. We write it down in order to be better and prepare for the next new wave or this new normal that it's going to appear, but we don't know exactly how it would be and when it will arrive.
Oh, fantastic. So we've almost come to the end of our session, but I'm just going to open it up and see if John or Hernan or Elizabeth have any final closing comments for the audience.
In my side, I see compliance as the way to meet the stakeholders' expectation. And when we are talking about the bigger scope of the program, when we are talking about changing the culture, the services that we offer, I foresee that compliance, risk management, governance in general, internal controls, auditing, will all go to support new strategies to keep risk really addressed, to monitor new requirements. We got the stimulus packages that we need to maintain some new controls. We got also to look for regulatory reliefs and so many things that we need to work together in the second line of defense, integrating governance, risk, and compliance with the same platforms that people can have the same information in time. So for me, digitalization, working with governance, risk, and compliance solutions is key to be prepared, as Elizabeth said, to the new wave that we don't know when it's going to hit. But definitely we will see at least a new wave in the economic impact of coronavirus.
Thank you, Hernan.
I might offer that one thing we didn't talk too much about was specifically tools that can be utilized to help the compliance function identify, manage, measure the different compliance and regulatory risk spaces. And it's something that we're spending a lot of time on developing internally, leveraging third parties to really help us inventory and communicate the compliance risks, compliance issues that we have across the organization. And I think that really to what Hernan said, budgets are continually tightening and need to be managed. And it's increasingly important for compliance programs to be sensitive to how we support the organization, both in helping them mitigate risks, but also manage their manage the economic impact of the program, and using some of the more sophisticated tools to inventory those risks, to manage them, to score and risk assess and report on them will be increasingly important in the coming years.
Absolutely. I think that as we've seen an acceleration of organizations wanting to digitize their governance and risk programs, the tools I think are just going to become much more an important part of your whole program, right? To provide you the insight you need as you're going to be collecting more and more information and identifying emerging risks. So I just want to thank our panel, John, Hernan, and Elizabeth. You guys have been great, and really thank you for taking time out of your day to share your learnings and your comments and thoughts about compliance and the regulatory change with our audience. So thank you.
Thanks very much.
Thank you very much.
Thank you for the invitation.
Great. Thank you, Anna, for that great panel. All right. As we wrap up, I'd like to draw your attention to one final poll, which should be coming on your screens anytime now. And thank you, everyone, for joining us today for the GRC Summit Leadership Series event. We had a great day with numerous global thought leaders sharing their insights on fortifying risk and compliance programs for future readiness and reliability with effective continuous control monitoring. We had a panel on Align to Thrive, how to integrate risk and compliance programs across the enterprise. And also about a topic of optimizing compliance programs in a dynamic and distributed business. We had thought leaders from National Australia Bank, Fannie Mae, Hsbc, Banco Santander, Capital One, Zurich Insurance Company, Standard Chartered Bank, Nationwide Building Society, Bank de Groof Peter Cam, Intercontinental Exchange, and Danske Bank. We hope you found these sessions insightful. So our next GRC Summit Leadership event will take place on the 20th of August, and that focus will be on third-party management. We hope to see you then. Thank you and goodbye.